Hey everyone, and welcome back. Today, we're diving into a company that could be a serious dividend machine for your portfolio, Abu Dhabi's massive utility company, TAQA. If you're on the hunt for some steady income, you are definitely going to want to stick around for this.
So let me just ask you this. Are you tired of searching for a stable, solid dividend in a market that feels, well, a little all over the place right now? If you're nodding your head, then TAQA might be something to put on your radar.
All right, here's our game plan. First, we're going to meet TAQA and see what they're all about. Then we'll crunch the numbers. After that, we'll look at the good stuff, the reasons to invest, and the not so good stuff, the risks. And finally, we'll wrap it all up with a verdict. Let's do it. Okay, first things first, let's get to know the company. Before we can even talk about whether it's a good investment, we need to understand what we're actually looking at. And takeout, well, it's pretty much the engine that powers Abu Dhabi. So who is TAQA, really? Think of them as the essential lifeblood for the capital. They're majority owned by the government, which gives them this incredible layer of stability. They provide over 90% of the city's power and water. I mean, that's practically a monopoly. And on top of all that, they own a huge piece of Masdar, the renewable energy company, which is a fantastic play for the future. Now, this is where it gets really interesting for an investor. Take a look at where their money comes from. Over 90% of it is from that regulated, super predictable utility business. You know, turning on the lights, running the tap. That tiny little slice on the side, that includes their old oil and gas business, which they're getting rid of anyway. This massive stability, that is the core of this whole investment story. Okay, that stability is awesome, but let's talk about what really matters for our portfolios, the numbers. Does this actually make sense from a price perspective? And here it is, the big headline number that gets all the income investors excited, a projected 5.5% dividend yield for this year. To put it simply, for every $100 you put in, you can expect about $5.50 back in cash every year. That's a really attractive cash return in today's world. But, you know, a number is just a number until you compare it. So how does TAQA look next to its main rival, DEWA? Well, as you can see on some key valuation metrics, TAQA actually looks cheaper. You're paying less for its earnings. And on top of that, it's paying you a higher dividend. Kind of looks like a better deal, right? And listen, it's not just about that dividend check. When you combine that income with the potential for the stock to actually grow in value, analysts are thinking the total return could be somewhere in the 9 to 11% range per year. That is a really solid mix of getting paid now while your investment grows over the long term. So the numbers are looking pretty good. Let's pull all the positive points together into one place. This is the bull case. Basically, all the reasons investors are feeling pretty optimistic about this one. So the argument for TAQ and you is actually pretty straightforward. You've got that rock-solid, predictable cash flow from the utility business, which funds that awesome dividend. But it's not just some sleepy, boring company. It's got growth projects in the pipeline and that huge exposure to the future of green energy through Masdar. And maybe the best part? The company is in great financial shape with very little debt. All right, but we're smart investors here, right? We always look at both sides of the coin. No investment is a sure thing. So let's do our homework and look at the potential downsides. It's time for a necessary reality check. Okay, so what could possibly go wrong? Well, the big worries are things like the government changing the rules, the company being too focused on just one city, or getting hit by volatile oil prices. But here's the good news. For each of these risks, they seem to have a pretty solid defense plan. Their returns are locked in with long-term contracts, that Masdar investment gives them a global reach, and, like we said, they're actively selling off their oil assets.
So we've seen the good, we've seen the bad, we've looked at the numbers. What's the bottom line here? Let's put it all together and figure out if TAQA could be a buy for your portfolio.
You know, I think this quote from a recent analyst report just hits the nail on the head. A compelling mix of income stability and defensive growth. That's the whole story in one sentence. You get the stability from that core utility business, and you get that defensive growth from their expansion in renewable stake. And so, the final verdict from the pros is a buy. But, and this is a big but, it's for a very specific type of investor. If you're looking for stable income and growth that's a little less risky, this could be for you. This isn't a get-rich-quick stock. Think of it as a solid foundation. Which leaves us with one last question to chew on. In a world that feels pretty volatile, is a government-backed utility with a near monopoly and a solid dividend the ultimate sleep-well-at-night stock to add to your portfolio? That's the real question. Thanks so much for watching.